Hi, my name is Khush Munga. Welcome to our channel. We are going to do our discussion with a broker from ANZ, a mobile lender, who is going to tell us more about general questions that get asked in our home opens and with the clients, and few more information that you or I may not know. So I'll hand it over to Abhi.
So thanks for having me here, Khush. It's pleasure to be here, and I'll try my best to answer questions to best of my ability so that this information can be utilized by the viewers and your potential customers in future.
Thank you so much. So Abhi, ANZ is one of the top 4 banks, and you've been working with ANZ for how long?
Roughly, including all different positions, it's about 16 years now.
16 years,
Yeah.
wow. And you have been awarded as a top mobile lender in WA, New Zealand?
Yeah, it was a particular year back in 2016-17. Yeah.
Wonderful,
Yeah.
congratulations for that. So Abhi, a lot of the clients know that of course they need to borrow money from the bank, but they are not aware of different type of loans they can get, what are difference between the different type of loans and stuff. So just to start the conversation, what are the different type of residential home loans are there?
Okay. Look, I mean, broadly categories, if you look at it, is basically either you're buying a residential property or you're buying an investment property. That will then make that distinction between it's the owner-occupied home loan or an investment home loan. And then once you kind of figure that out, within that you have an option to either keep that loan as a variable rate loan or fix it on a fixed rate. Basically, that's the broad category. Within that, then obviously there could be, in investment specifically, you could be buying a property or you could be using the equity to use that investment loan to buy shares. And again, you can either keep the loan variable on a variable rate or you could fix on a fixed rate.
Okay. And there is a thing called offset that is against a variable or fixed?
Offset is always against variable. Once you fix a loan, vast majority of banks will not allow you to offset the fixed loans because they are already giving you a certain fixed rate for a period of time. They will all allow you to have an offset account against the variable loan. Some banks, including ANZ, will allow you to have an offset account against the 1 year fixed loan.
1 year fixed.
1 year fixed loan. So you can still fixed and you can still have an offset.
And it's 100% offset?
100% offset.
Oh, wonderful.
Yeah.
Oh, that's good. I don't think a lot of banks do that, so that's a good thing. Does everyone, when they're applying for loan or borrowing money, does it all have to be variable or a fix, or do they have third option?
Look, it all will come down to where the economic climate is, what the forecast is, where the sentiment is that if the rates are going to go up or rates are going to go down, and that will then translate into people then picking up different options. So to give an example, back in the COVID days, obviously every bank was throwing a really good or low fixed rates, starting from 2s, and everyone wanted to lock that in. So at that time, a lot of people split their loans, put a big portion on a very low fixed rate for 2, 3, 4, 5 years, and had a small portion in variable, or maybe fixed the whole lot. Fast forward to 2024-25, where the rates have gone up about 12 or 13 times. Fixed rates were even higher when the rates were on the rise. So nobody wanted to lock themselves in those rates because everybody knew that we'll get to the peak and then the rates will start coming down.
You mentioned split, so they can split their loans?
100%.
Is there any fixed percentage that they can split their loans?
No, it could be anything. So if, for example, if someone is borrowing, call it 600, 700,000, they can fix whatever part of it they like and they can keep whatever part they like variable.
Okay.
Most common, I guess, formula that I have seen people utilizing is they have an idea of how much they're going to save and how much they practically can pay off in a year.
Yeah.
So let's say somebody is picking a 3-year fixed rate and they are locking in 500 out of the 700. They know that the remaining 200 is the portion that they are planning to pay off.
Yes, okay.
So by the time the fixed rate comes out, that little portion is paid off, and then they can go and do the same thing again. Split the remaining loan and then pay off a small portion, so on and so forth. So in 10-15 years time, the residual loan is very low.
Okay, and they can also offset against that split variable loan,
100%,
right?
100%,
yeah, okay,
100%.
which they
So
can save.
whatever portion is variable, you can always have an offset against it.
Okay,
No problem.
yeah, okay. And what are the pros and cons of like having a split loan other than being able to pay it a little bit more faster?
Look, there is no cons as such, because effectively the total loan amount is still the same. You just ended up splitting it, and there was probably a good reason to split it, because you were trying to take advantage of a really good low fixed rate.
Yeah.
For example, what happened in COVID days. So if that was the purpose, because of you split it, now you're enjoying that low rate on a big portion of your loan for a few years.
Yeah.
And as and when it comes out, you restructure the whole lot.
Yeah.
So the pros are that while you are fixed on a big portion, you still have a portion where you can pay as much extra as you want.
Yeah.
You can offset it, you can redraw from it, and you can practically clear that portion without any penalties.
Yeah.
Because on the fixed portion, there's always restrictions. You can't pay over and above a certain amount,
Yeah.
which is different for all different banks, but usually it's somewhere between $5,000 and $10,000 per year.
Per year, yeah.
So then you're stuck, because you have more savings, but you can't pay in those. So by splitting it, you kind of get best of both worlds.
Yeah.
You got a low rate on a big major portion of your loan, while you still have the flexibility to pay as much as you want on the small variable portion.
Yeah. And that is something you do guide your clients through?
Yeah. So again, it depends. If fixed is something we are going with, we would give them that option that, hey, look, rather than fixing the whole lot, we would recommend that you consider this option where a small portion is variable for X, Y, and Z reasons, and this will benefit you.
Okay, good. And what is the difference interest rates currently with ANZ for your prime residence and investment home loans?
It's a very good question. This has kind of emerged over last 2-3 years mainly. So look, historically banks were pricing loans based on the total lending amount. That was pretty much the main criteria back in 2012 and 13. Slowly and gradually that kind of dwindled down, and especially after COVID, banks are really pricing the loans based on the security on the back of it. So when I say security on the back of it, basically most commonly used term in our world is LVR, which is loan to value ratio. What is your loan against the value of your home? So now they are obviously giving bigger and better discounts if your LVR is low. So to put that into perspective, let's say someone is buying a property for $500,000 and they want to put in 10% deposit, so they are borrowing 90%, so their LVR is 90%.
Yeah.
In that case, they are over 80%, which means they are paying lender's mortgage insurance and all the rest. Whereas someone who is buying the same property putting in 20%, now their LVR is 80%. So anything which is below 80% are usually on a much better rate. When I say much better, it is not a difference of 1 or 2%. We are looking at a difference of somewhere between 1.25% roughly, depending on the total loan amount and few other factors. So for example, if you're buying a property for $500,000, you're at 80%, you're probably getting the best discount possible right away. If for some reason you don't have enough deposit and you have to borrow 90%, it's not the end of the world. Yes, you're starting on a slightly steep interest rate, but that value of the property and that loan is not going to stay the same for the remaining 30 years of the loan. Over a period of next 2 years, 3 years, 4 years, as the value goes up and the loan comes down, these loans can be repriced, I would say once every 12 months at least, because value is not going to change massively in 3 to 5 months. So once a year, if the valuation gets done and we look at the LVR again, so somebody who could have started on 90%, after 12 months they could be on 80%, and suddenly they'll go on to that lower rate. And within owner occupied and investment, again there's a difference of 0.25% to 0.5%. So as to not to confuse, because there are a few things in here, what people need to remember is to get the best rate possible, try to have 20% or more deposit, but it's not the end of the world if you have less deposit and you have to start on a little higher rate. So be it, get in the property market, buy your home, because you will get on that better rate within a year or two, if not longer. And investment rates are usually again 0.25% to 0.5% higher than the owner occupied. A lot of people ask, why is that? The main reason is that banks have to put capital aside. For every dollar they lend to every customer, there's a percentage of that loan amount that they have to put aside in capital. That's the money which is dead money for them. They can't use it, and it's APRA ruling, right? and for investment loans, that percentage is higher than owner occupied.
Okay.
So there's more money they are putting aside to give an investment loan,
Okay.
and they have to recoup that from somewhere.
Yeah.
Hence why difference in the interest rate.
Okay.
And that also keeps on chopping and changing slightly through EPRA rulings every 6 or 12 months. So you would find that that will translate in the rates they are offering.
Okay.
So about 2 years ago, owner occupied and investment, the difference was almost 1%.
Wow.
Now it is somewhere between 1.25% because that capital allocation requirement has changed.
Okay.
And same thing again applies if you want a loan interest only.
Okay.
The minute you go in interest only, the capital allowance that they need to put aside is even higher. So the more money they have to put aside to give you that loan, higher the rate is.
Yeah. Okay.
And same thing works with the LMI loans. So if you are in the LMI category, which means over 80% lending, then they have to put more capital aside.
Okay.
So if they have to give more money out and they can't use it, which is more funding required, they have to then translate that into interest rate. And luckily, well, whichever way you look at it, that ruling is same for every lending institution in Australia. Hence why, more or less, they will all price their loan in the same fashion. There could be a small difference here and there, but pretty much they're all around the same mark.
Just because you mentioned, and I remember, there are also some of the profession who, being in that profession, can borrow up to 90% and not pay LMI. What professions are those professions?
So every bank has a slight different category because they all want to create their own niches. But there's a couple professions which are pretty much a standard across the board. So with us, with ANZ, so if you are a medical client, which means you are in medical profession, again, there's categories in there. So not everybody in any capacity in medicine will be able to get it. So we have a list, but in general, if you are a GP, if you are a dentist or some kind of a specialist, you can borrow up to 95% without paying any LMI.
It's 95%.
Yeah.
Okay.
Again, within that, you got to be an existing customer with some sort of accounts with us to go up to 95. If you're brand new, it's usually 90, but they are allowing 95 in a lot of categories now. And same thing will apply to lawyer and accountant.
Okay.
But they have to have certain membership with the relevant industry bodies. So for example, accountants, they need to be a CA or CPA member.
Yeah.
For lawyers, I think they need to be a member of the law bench or something.
Okay.
So they have a certificate that we need to request.
Okay.
And as long as it's active, then they can,
Good. Okay, that's a good thing. And with the interest rates for them, if they are buying investment property, would be a similar interest rate that's going to be given to everyone else?
Yeah. So rate is always going to be based on what's the final loan to value ratio. Are you below 80, over 80?
Okay.
And also one thing that also plays into it is the total amount of lending that customer holds with a bank.
Okay.
So for example, if you just want a loan of 600,000 at a certain LVR, you will get certain discounts and they'll be right. But suddenly if you say, look, I've got two other loans which I'm happy to bring over and overall LVR is the same, the total lending is now double or more. So in that case, the discount will improve on every single loan, not just that one.
Okay.
So it is better for people to actually have all their loans with a lending institution because that's where they will be able to get the highest discounts possible.